Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is former Wall Street bond trader at a number of large banks. He writes the Mining Stock Journal and also the Short Sellers Journal. Dave Kranzler, thank you for joining me again.
Hey, Jason, how's it going? Thanks for having me back on. Just one quick correction. I traded junk bonds for 9 years at Bankers Trust and then pulled the ripcord when it was acquired by Deutsche Bank and decided to move back to my home state of Colorado.
Oh, I thought you also worked at other banks too in your career on Wall Street.
Well, I worked at Goldman before business school and also a small boutique investment firm.
Okay, just for people who are curious about your background, because I know you do all these interviews and people don't ask you about your background that much. They mostly just focus on your newsletter. So we'll ask questions later in the interview drawing on your background because there's so much shenanigans going on right now with the commitment of traders data, the commodities, the CFTC, the CME Group. There's actually something hilarious. I don't know if you saw it. We'll talk about it in a little bit. But first, I want to get your thoughts on the stock market rally that's been happening the last couple of weeks. Do you think that the stock market rally, is it a short covering rally, or do you think it's jumping the gun that the Fed is going to end the rate cuts soon?
I mean, the market is, well, first off, there's just the majority of the stock market participants right now, at least the really active ones, I think, weren't around. They're millennials, Gen Zers, whatever, and they weren't really around for previous bear markets. I mean, you can't really count the quick decline that we had during the COVID period because of all the massive amount of money printing saved that. I mean, and there was going to be the market was starting to go into a bear back then, even before anyone heard of COVID. So, or when, before or right as the COVID stuff was just starting to, you hear whispers about it. But so certainly most of these people missed the great financial crisis bear market, the dot-com bear market. There was I don't know if it was an official bear market, but there was a downturn in the early 1990s that was somewhat, not fun. So I think, the only way these people know how to trade and invest is in an environment where the Fed is printing a massive amount of money, expanding its balance sheet, and either reducing interest rates or keeping them pinned at zero. And so it's just what stands out for me and what has stood out for me probably since September. I think the Fed started hiking rates in March, 2022. But since September, it's like the market is begging. It's like a heroin addict on withdrawal and it can't get any more heroin. And it's just begging for the Fed to either stop hiking rates or to do a complete pivot and start printing money again, because that's the only way these people know how to trade and invest. And that's not real trading and investing, as you're well aware.
So it's just very short-term oriented right now.
Yes. And I mean, so what we've seen since, and you can really, this bear market started in November of 2021, because that's when the NASDAQ started heading south. And then the rest of the stock market followed suit in, right after the first of the year at the beginning of 2022. And so really what you've seen is just, a series of brief bear market rallies. And I mean, they're all characterized by, you get a rapid run up, a ton of short covering, and the speculators keep gravitating back to the same stocks. I mean, the best performer. So you could say this market really started moving higher again in early October, and it ran up, and then we had a brief sell off. Looking at a daily chart right now, and then it headed higher. It started heading higher again right after New Year's. And it's like Goldman's most shorted basket of index of most shorted stocks has been like the best performer. The meme stocks have been great performers. And those are, it's the same garbage that the speculators gravitate to. And you've also seen a massive explosion in same day expiration options or the weekly options. Just massive explosion in that volume, and that's just it's classic signs of just rampant drunken sailor speculation, and that's not characteristics of a market that's bottomed and is starting a new bull market. And so I think it's quite possible that the current rally is over. It's the jury's still out, but it looks like we're going to start heading south again. There was an interesting statistic when you just to circle back, you asked me if this is short covering or what. And I found a nice little tidbit for my short sellers journal that comes out weekly on Sundays. And according to Goldman Sachs prime brokerage desk, right? And the prime, for people who are unsure or unclear, prime brokerage desks primarily handle hedge funds and very high net worth individuals. And between January 31st and February 15th, short covering in the NYSE tech stocks was the second largest on record over any 12-day trading period in the past decade, which probably means ever. So,
does this remind you of
buying in the tech stocks on the NYSE? So that's everything, right? That's the NASDAQ, that's the big board, and what I guess is formerly known as the American Stock Exchange. And so the trading in the tech stocks was 80% short covering and 20% net cash or margin buying. So there you have it. It was a short cover rally that was accompanied by just idiotic speculation in the idiot stocks.
Well, you have trend following. So once the short covering rallying starts, it starts to feed on itself, because then you get short squeezes, you get stops blown out, and you get the momentum traders that are looking at the patterns on the charts piling in. So that's why these trends get pushed one way or another. We're seeing this in natural gas right now. We're recording this interview, by the way, on Friday, February 17th, 2023. Does the behavior, Dave, with this rally and the short covering, does this remind you of the bear market rallies that happened in 2001 after the tech bubble crashed?
Very much so. It's very, almost identical. Where, back then it was the same, the crappiest stocks with, not a lot of revenue and no prayer of being profitable. And most of them eventually went out of business were the ones that moved up the most during those rallies.
Now, if I was running one of these companies it's a kind of a tech play, it has tech in the name, or the business model claims it's tech, it's really not tech. It's maybe like kind of a middleman or a service website or something like that. I would be debating, and we've seen some of this with some of the insiders already, insider selling. So I would be offloading my shares into this rally, this big rally, because some of these shares are up over 100% in under a month. Given except for the last couple of days when they've pulled back a little bit. So do you expect to see a lot of insider selling by these senior executives, and then also capital raises soon? Because if the shares are up a lot and you have a bad balance sheet, you don't have profit margins or free cash flow, you always need capital.
Yeah, I don't. Well, we just saw Bed Bath & Beyond take advantage of the big run up in its stock, and Bed Bath & Beyond is basically dead man walking. Even with the capital raise that they got done, they'll probably be bankrupt by the end of the year. So it just saved them from going bankrupt, by like maybe 9 months. And it's an example of just really incredibly poor capital allocation by our system, because Bed Bath & Beyond shouldn't have been given a dime to stay in business. They're not gonna save the jobs. They lease all of their real estate, and there's really no reason for it to exist. I haven't been in one in quite some time, but I always found it depressing to walk in one.
Well, Dave, you also have companies like what Sales Now or Service Now, the stock ticker is Now, and the guy goes on CNBC, right, pumps the stock, talks about the company's doing pretty well, not a recession, and then you find out 10 days later he sold about 90% of his shares. And
yeah, Now is actually on my list to look at for my short sellers journal. But to answer your question about insider selling, I don't really pay a ton of attention to the relative amounts of insider selling because, for the past several years, 90% of what insiders have been doing, or 95% of with regard to their stock, is selling it. And when you
and
pull
using
up some
buybacks to protect the share price, right? Share buybacks with debt.
Right. They issue debt and buy back shares so that the insiders can sell into a stronger bid. If you look at some of these services that track insider buying and selling, a lot of what is represented as buying is really just the exercise of either zero cost or very low cost stock options, and then they turn around and sell them, sell the stock. So my
other point I wanted to make sorry to interrupt you. My other point I wanted to make on the insider selling, though, was I very seriously doubt that insider selling for doing pump and dump on business television, right, and offloading his shares, I doubt he's going to even pay a fine from the Securities and Exchange Commission.
No, the SEC doesn't care. I'm surprised, Elon Musk obeys the insider sales regulations, and that, who knows, there's a chance he may skirt the rules in some fashion, but the SEC doesn't really care much about anything. They're on the same take as every other government entity and government employee.
It's a revolving door of corruption because, a lot of the people work at the Securities and Exchange Commission. If you go and read the books with Harry Markopolos, who was a whistleblower for the Madoff Ponzi scheme, or books about the Madoff Ponzi scheme, the majority of people inside the Securities and Exchange Commission are lawyers. They don't even know how to read financial statements to find accounting.
Well, and they take those jobs so that then they put in their time at the SEC, and then they go work for a Wall Street bank. And then they know all the insiders at the SEC and all the the lifers at the SEC and how the system works, and it makes it easier for them to represent their clients when in SEC related matters. Same thing with the Justice Department. I went to high school with a good friend of mine. Actually, was in school with him from elementary school, and that was one of the reasons he went and worked at the Justice Department, so that he could get a fancy white shoe law firm job.
Exactly. It's a revolving door of corruption. So whether you're going to go, if you work at one of these regulatory agencies, whether the Securities and Exchange Commission, the Commodities Future Trading Commission, so the CFTC, you're building contacts there, you're gaining knowledge of how the system works. And then a lot of these guys want to go make a much higher salary, 10x, 20x with stock options. They go and apply to either work at a bank in the compliance department if a lawyer. They either can work in compliance at a hedge fund, a large hedge fund or family office, or they could go work as a lawyer at a white shoe law firm. They can make partner quicker at one of these white shoe law firms that's connected to the banks, or they can come here to DC and they could go work on K Street at a lobbying firm for either the banks or the hedge funds or high frequency trading. So this is the revolving door of corruption. And unfortunately, and we're going to talk about this too, this is connected to precious metal market manipulation and stuff the banks get away with, because a lot of the people that worked at the CFTC in the Chicago and the CME Group and the banks and others, it's rotating between those things. It's been covered in many different articles. I think Craig Hemke, at TF Metals Group, he wrote a long article about this revolving door corruption with the banks and the CME Group and the CFTC a number of years ago.
Yeah. Oh, and John Titus of Best Evidence Videos, which are on YouTube, he's done exhaustive podcasts about this. It's mind-blowing how corrupt it is.
So let's talk about that. In the last week or so, the commitment of traders, the data that's supposed to be released by the banks, the bullion banks and the large banks for a lot of different commodities futures, it's been delayed over a week. I think they gave some bullshit excuse for it. But the banks, Dave, you've been covering gold and silver for a very long time, way over a decade. The banks just get away with so many things. People who are new to this, new to gold and silver, or forgotten, the banks actually got fined for a totally fraudulent commitment of traders report. It was, I don't know, 6 to 8 years ago. And
it was JP Morgan, and what they were doing. This was I think it was 2012.
it
Yeah,
was a long
I've
time
been in
ago.
this sector since 2001. It was JP Morgan, and what they were doing is, I mean, obviously you know what the commitment of traders report looks like, but there's various categories that the trades belong in. There's the producer merchant category, the swap dealers, and those are the banks, and those are known as the commercial traders. And then there's the managed money, which is basically CTAs and hedge funds. Other reportables, which no one has ever been able to get a direct answer from the CME on what exactly, or the CFTC on what exactly is the other reportables is comprised of. It's thought to be like family offices, very high net worth individuals, not for profits or whatever, things like that. It's essentially non-managed money, funds, pools of capital. And then there's the unreportable positions, which are the retail traders. And what JP Morgan was doing was they were putting trades in the other reportables category that actually belonged in the swap dealer category. So it was completely misrepresenting the character of the commitment of traders report, and they were handed a whopping $650,000 fine by the CFTC, told not to do it again. Which, of course, they just for them, that's the cost of doing business. I mean,
that's like a weekend of partying, maybe. It's like a bankster getaway.
Exactly.
Yeah, I think there was other instances too where they said the data was fraudulent. I don't know if it was that specific one, but I think there's been a couple over the last 10 or 12 years but the fines were at most a couple $1,000,000. I mean, it's the cost of doing, but it's not even a slap on the wrist compared to the billions of dollars these banks make trading derivatives and stuff they get away with. Dave, did you see?
Well, here's what I like to ask people about the commitment of traders report, and also the COMEX, because these come from the data, at least for precious metals, on the COMEX. And so it's the same thing with the COMEX vault report, the warehouse stock report, and the open interest report. The data is originated by the banks. It comes from the banks, the COMEX banks. And so do you believe that the COMEX banks honestly and ethically are reporting the data that they are the custodians of and the originators of? Because if they are reporting this data honestly, it's the only part of their business line, the only part of their business model that they are reporting honestly. I mean, there's accounting fraud in every other aspect of bank bank financial reporting. So what are the odds that this data is of 100% integrity? I say zero.
The banks are allowed to get away with whatever they want. I know a money manager who tried to take delivery of 1 ton of physical silver from a COMEX contract. He asked for delivery, I think back in 2008 or 2009, for 1 ton of physical silver, and he was told he has to wait 6 months.
Wow.
So, I mean, and there's no extra fines. I mean, the CFTC, there's been examples when the physical market is tight. I mean, they were offering cash settlement. So it was 60, 70, 80% premiums to cash settle. Zero Hedge was reporting on this, during the silver squeeze in 2011, when silver ran up to 48?
Yeah, 49.
Yeah, and in a rational, common sense commodities market, right? If they don't have the commodity and they sold the futures contracts, they're naked short, they shouldn't be asked. It should be illegal for them to offer cash settlement. And look, I think was it Morgan Stanley or was it another bank that sold their custodial silver? It was in Europe. I can't remember which one. And there's a bunch of class action lawsuits and fines. It was a bullion bank in Europe. They sold their custodial silver.
Huh.
This was 7 or 8 years ago.
Those off COMEX settlements the what do they call them? Exchange for physicals, and then the privately negotiated transactions. The PNTs, I would bet that the large majority of those PNT transactions are for cash. I mean, the cash settlements happen every right before every first notice period.
Yeah, the people who aren't cash settled are the industrial end user. So if you're like Samsung or Apple Computer and you need, or a solar panel manufacturer. So if you're an actual industrial end user and you need the silver, the banks and the refiners will get you the silver. It's the actual investors and the money managers who want delivery who get screwed.
Yep.
Dave, did you actually see, so on Tucker Carlson, the CME Group CEO and chairman of the board, he went on Tucker Carlson about 2 or 3 months ago to talk about FTX and Sam Bankman-Fried. And did you see his Freudian slip on live TV on Tucker Carlson on Fox News?
I didn't see it live. I think Zero Hedge had the video posted, and so I saw it then. I don't remember exactly what he said.
Oh, so I didn't see it live either, but I saw the video clip later. But he said on live TV and it's recorded, he actually admitted he bribed the CFTC regulators. So he said that Sam Bankman-Fried at FTX did not do a good job of bribing the regulators at the CFTC.
He tried to.
Hmm?
I think the story was he tried to bribe the guy.
Now, Dave, given your experience working on the trading floor and trading at banks, what type of stuff did the banks get away with? I mean, did they get away with tons of market manipulation, felonies, accounting fraud, and what at worst, did they just pay a fine most of the time?
Well, that's I mean, I can tell you firsthand what some of the things that went on at Bankers Trust while I was there. And remember, this is the 1990s, and things were corrupt back then, but not even a tenth of how corrupt they've become. And back then, part of the game was to try and hide what you were doing. Things that were coloring, quote unquote, coloring outside the lines. Part of the trick was to hide it from the compliance department, because back then, the compliance people actually did their job. Now they just look the other way because the more that the people that they're supposed to be enforcing regulations on can get away with not abiding by the regulations, the bigger everyone's bonus pool is, right? So it's all dictated by money and bonuses, and Wall Street is the epitome of that. So, for instance, back then, Bankers Trust was a pioneer in derivatives, over-the-counter derivatives, and they were actually nailed screwing over Procter and Gamble. It was a very high-profile situation at the time, but the derivatives guys were making a small fortune off of. And I don't remember exactly what it was that they were doing, but it was, even by today's standards, what they were doing was pretty egregious. And the derivatives trading desk was not that far from the high yield trading desk on the trading floor. Although we were so wild, our desk was so unruly that they eventually moved us into our own trading room. It was pretty funny. But we would do things that, we would try to get away with whatever we could to try and, maximize the profitability of the desk. So a perfect example was that, if you remember, during, when the S&L crisis happened and Drexel went bankrupt, and, that's probably the last time that high-profile Wall Street executives ended up in jail. If you want to call where Michael Milken landed a jail, but
he was blackmailed, though. I mean, like they said, the government did a bunch of stuff to force him to go to prison because they were going to throw the book at his brother and other stuff. So I mean, he created.
Well, but they should have. That's that you got to do what you got to do to get these guys to squeeze information from these guys. But and they can afford the best lawyers in the world. So but what happened was a lot of the bonds that ended up in S&Ls, because S&Ls were big investors in these junk bonds back then. A lot of the bonds were distressed. And if you remember, there was an entity called the Resolution Trust Corp that was formed by the government. It's a government-owned entity that essentially took over these bond portfolios from S&Ls. And so a couple years after they took them over, they started sending lists around Wall Street to, conducting auctions to sell them. In many cases, these bonds were trading at less than 50 cents on the dollar. And there was a company called Pamida. It was a Nebraska-based five and dime type store, like a Woolworths or a Walgreens or something, kind of similar to that. And they had, Drexel had done a junk bond underwriting, several of them for them. And these bonds ended up at the RTC. And the RTC had no clue, what the price, what the pricing was on this stuff. Because back then, the junk bond market was, somewhat opaque. And
it was brand new. Didn't Michael Milken create the junk bond market?
He certainly, I don't know that he necessarily created it. He created it as we know it.
Oh, okay.
But yeah, I worked with a handful of people who actually worked under Milken in the Beverly Hills Drexel office. And believe me, these guys, you didn't want to turn your back on them. And they would steal money from their mother if they could get away with it and not feel guilty. But so at any rate, I started doing some of my own financial analysis of Pamida, I looked at this. I asked our head trader, where he thought a reasonable starting point was. And he's like, well, let's assume 50 cents on the dollar, right? So 50% of par value of these bonds. And so I did this analysis and I was like, these bonds are worth par. I mean, this company has the cash flow to service the interest on payments. So I went around to some of the more aggressive accounts on that we covered on the desk, and I got a handful of them teed up. One of them, as a matter of fact, although this wasn't necessarily a regular account of ours, was the Glazer. The Glazer family, Malcolm Glazer. They own the Tampa Bay Bucks.
Yeah, I was going to say that, and a soccer team. I think Manchester United, but they want him to sell it.
Yeah, that's right. They own Man U. They own a lot of things. They also own mobile home parks, residential mobile home parks, in upstate New York. Extremely wealthy family. But anyway, so I basically, went around and got, a handful of accounts interested in paying like 60, 65 cents for these bonds. And I was actually comfortable that they were worth, if not par, they were definitely worth more than, where we were going to be able to trade them out of the RTC. And so this was right after the NASDAQ had passed a regulation that there was a 5% rule, right? So there's riskless trades and then there's principal trades, right? Principal trade is when a trading desk actually buys the security and holds it at least overnight and takes risk on it, right? It takes at least overnight risk. And then there's the riskless trades where you have an order from an account, from a buyer at a certain price and a certain quantity. And then you go out and you try to buy the bonds as cheaply as possible and then trade them into the account, because you can use their bid to go around to holders of the bonds and try to source paper to get the trade done, right? And you basically cross the trade at the same, you buy them and sell them basically at the same time. So the NASDAQ had just passed a regulation that you couldn't have more than a 5% markup on a riskless trade, right? And so, well, as it turns out, the trader decided, he actually bid 50 cents on the dollar to the RTC for these bonds, and they tattooed that bid so fast, it spun the trader around in his chair, but so we had a problem on our hands because we had bids at 65 cents on the dollar for these things, and that's obviously more than a 5% markup. So we couldn't. It was essentially a riskless trade, but we couldn't book it as a riskless trade, right? We had to book it as a principal trade. So we went around, the salesman went around and told their accounts, we waited till the end of the day, and, it was like, okay, now call back your accounts and tell them the trade's going to be done, but we can't do the paperwork on it until tomorrow because it's so late in the day. And so essentially we were able to book the trade as a principal trade because, we went in and bought the paper from the RTC, held it overnight, and then the first thing in the morning the next day went and filled the orders. And it was a wildly profitable trade for the desk. It's kind of funny as an aside. So the Glazers, and I was dealing with one of Malcolm's sons, and Avi, and and he got his brother involved and Malcolm involved. And so what happened is like a couple of days after we did the trades with them and filled their orders, these checks for millions of dollars show up to settle the trades. And our back office completely flipped out. They were worried the checks were going to bounce, blah, blah, blah. And they were issued by Sun Bank down in, I think it's SunTrust or Sun Bank down in Florida. And so to calm down the back office people, I called Sun Bank down in Florida, and I said, hey, I know it's not a problem, but my trade settlement people are freaking out. Are these checks going to clear? And the lady who I was talking to just laughed. She goes, Malcolm owns this bank. Of course they're going to clear. So, that was like an example of, the types of things that we would do to get around the regulations, and not only just to get around the regulations, because everyone tries to get around the regulations now, but also to do it in a way that we wouldn't get nailed by the compliance department for breaking the regulations. Now the bank compliance department could care less. It's like, look the other way, like everything else.
Or they just keep holding the derivatives and don't take mark-to-market losses because as of March of 2009, the large banks here in the U.S. do not have to mark-to-market. So no generally accepted accounting principles, what they're mark-to-model, since the rules were changed by the FASB, and then they just wait for the Fed to do some type of bailout if one of the banks is about to fail. It's a covert bailout or currency swap line, or the Fed just goes and straight up buys it and sticks it off balance sheet now in a special purpose vehicle.
That's right. Another thing that we would do is, when bonus period was approaching, if we had bad positions in our book, our trading book, as an example, I was running a big position in Trump Castle first mortgage bonds, and they rarely traded. Again, ultimately they were refied out at par. But back then, at this point in time, the bonds were probably quoted at 65 cents on the dollar. And if you wanted to move 10 million, maybe you'd get paid 50 cents on the dollar. And, back then 10 million was a pretty decent sized chunk for a junk bond position for a trading desk. And so what we would do, because what would happen is before the final bonus pool would be cut, the compliance people would look at every position in our inventory and try and get an independent mark to market on it, right? So that we wouldn't be fudging our prices on some of our illiquid paper,
So they were
to
trying
fluff
to
up
do
the
an
bonus
honest
pool.
risk assessment. They were trying to do an honest or somewhat honest risk
Well, they're
assessment.
trying to do an honest cut for the bonus pool of the profitability of the desk. So with these Trump bonds, we would have had to mark them down probably 15 points on, I think my position was about 10 million, so you're looking at a pretty big, it's about a $1.5 million mark to market write down on these things. And it's a pretty, and then that subtracts from the bonus pool. And so one of the things, and this wasn't the only example of when we did this, we did it actually that particular year was a tough year in the second half of the year for the junk bond market. And so, and I wasn't the only trader that had, bad positions and not necessarily bad, but at the time, had to be marked down. So what we would do is we would do a high yield derivative put call swap with Harvard Asset. And the salesman who covered Harvard Asset was also an extra Excel guy, and he had a great relationship with the portfolio manager there. This was when Larry Summers was the head of Harvard Asset Management.
So that's like, for our listeners out there, is that like kind of their pension fund or their wealth fund where all
it's their, well, yeah, I think it's their pension fund, but also their endowment. And so what we would do is we do a put call structure with, where we would write puts and calls, and then we would sell the bonds at an agreed upon price to the portfolio manager at Harvard, and then he would have an option to put the bonds back to us at, I think it was at the price that we sold them to him, and then we would have an option to call the bonds back at a higher strike price. So if we did the trade at 65 cents on the dollar, which is where I had the bonds marked, and it's just coincidental that these prices correlate with the prices on the PMIDA bonds. These aren't the exact prices, but they're pretty close. So it's just for sake of example. But it would get the position off our trading desk balance sheet completely, and Harvard would be the legal owner of the bonds, but they also would have the ability, to protect themselves, the downside of their trade by having the ability to put the bonds back to us after the new year. Or I think we set the date so it was,
I mean, this doesn't sound like Wolf of Wall Street type stuff from the book or the movie with Jordan Belfort, or it doesn't sound like what Michael Lewis wrote about in his book about the culture of corruption on Wall Street when he worked there in the 70s and 80s called Liar's Poker, or Peter Granditch's book where he wrote about how like a lot of the brokers at his Wall Street firms were front running people, or any of the stuff that Greg Manorino talked about on my last interview there for listeners in the archives about a month ago. So, I mean, the Wall Street has since the 70s and 80s, it seems like the amount of felonies and corruption, the culture of corruption exploded, especially with fiat currency and the rules changing. It's just gotten worse every couple decades in each financial crisis.
Oh, we would front run. If we could, we would front run when we knew that like Fidelity or Kemper or someone big was looking for a massive quantity of a more liquid bond. We would definitely front run them. we would load up ahead, because you find out from the salesman what the portfolio managers are thinking, and then you go out and you say, oh, well, I'm going to front run these guys, and then you go load up the bonds in your trading position and then retrade them out.
Well, now it's called high frequency trading, right?
Exactly. And we also, so back then, it also became, and I don't know if this was an actual regulation or not, but, and I think it might have been a regulation. We had to, the phones on the trading desk had to be recorded. So they were everything that you did and said was recorded, everything you said and did over the phone was recorded. However, we also had a phone to an outside line that was installed in our trading bank. It was one phone, and it was not recorded. So when you needed to have a conversation off the record with someone to get a trade done or to exchange inside information, we called it the bat phone. either I or you would see someone else like walk around the trading desk because the bat phone was right next to the head trader because he was the head sleazeball. And you see someone, walk over around the desk and pick up the bat phone and start talking on it. So make the phone call. It was pretty funny. It was actually one of those old push button phones.
It's just really interesting hearing about these stories. I mean, if you go back, like I said, and watch the old Wall Street movies, read the books from people like Michael Lewis, Culture of Corruption, or people that worked on Wall Street for a long time, and they're actually honest, you'll just hear all these stories. I've heard a lot of them over the years. It's very interesting hearing them and the stuff people got away with. I mean, the bankers, as you said earlier, Dave, the bankers are getting away with even more. We're on orders of magnitude, scales, order of magnitude larger now because of the derivatives, the Fed bailouts. Look how much, 3 trillion the Fed owns in mortgage-backed securities. God only knows all the shenanigans that the banks have done there.
Oh, no question about it. No question about it. Another thing, especially back then, the most amount of money was made if you had inside information. And Bankers Trust was the primary corporate banker for a lot of these corporate entities, as well as Donald Trump. And so, like back then, all of his casinos were financed with bank debt that Bankers Trust underwrote and syndicated. And the bankers see the inside numbers at these companies. And, everyone else, people who traded the publicly traded securities, there's supposed to be a Chinese wall, and you're forbidden from seeing inside numbers. You got to use the SEC filed GAAP numbers like everyone else. Well, I had a good relationship with one of the corporate finance guys who was a banker on the Trump account, and he knew I was either long or short Trump paper, and every once in a while he'd walk over and he'd tap me on the shoulder and he'd go, I think I really like those Trump Taj Mahal bonds. They look cheap to me. And that would be my indication, my signal to just load up on as much as I could, because there was, a corporate finance transaction that was imminent, that was either going to take the bonds out, or boost the trading value of the bonds. It was pretty funny.
So, Dave, I want to transition now to gold and silver. So we've had a lot of interesting mergers and acquisitions the last 6 to 12 months, mostly in the royalty and streaming space, but there's been some bidding wars actually for the medium size, low cost producers for gold and silver. So we've had Yamana Gold, a bidding war for Yamana Gold. The gold prices right now were below 1850 gold on the futures contract price in US dollars. Silver is back below 22 at 2171. Is capital available for the juniors, or do you think that the mergers and acquisitions activity is going to really just be for the larger miners like Newmont and Agnico Eagle? They're just going to focus on buying the lower cost, small and medium sized producers now because they can buy the reserves and the cash flow for cheap?
Well, that's a good question. Actually, the transaction that I liked the most that you didn't mention was the Hecla acquisition of Alexco. That's when they get the mine up and running efficiently and profitably, it's going to just turbocharge Hecla's earnings, because this is very high grade, pure. Well, I think it's almost pure silver mineralization, if not pure silver mineralization, and as a matter of fact, Hecla released an updated 43101 resource estimate, and they have a record amount of reserve silver now as a result of this acquisition. So I think that's a fantastic. I mean, I think all of acquisitions.
Well, if they can fix the mill, there were problems at the mill, right? Because Alexco, for listeners out there, Alexco has a very high grade deposits of over 600 grams per ton of a number of different small mines, but there was always problems with the mill. They couldn't get it run efficiently. They couldn't put enough capital in. Their balance sheet always had problems. They had problems with cost. So a larger miner with more capital, access to capital, can come in and fix those problems that a small silver miner probably couldn't fix.
You're right. And, the Hecla guys are proven operators. They're, old timers that have been around for a long time. They know what they're doing. So, but then Newmont is currently bidding for Newcrest, which that's actually that's a big merger if that happens. That's a big acquisition. I guess Newcrest told Newmont their bid's not high enough.
Oh, really? They said 17 billion wasn't high enough.
Yeah, and my guess is Newmont knew that was going to be the case, and so that the opening bid was just the start of the mating game for them. But yeah, if Newcrest has a lot of interesting assets on their balance sheet, I think that'll be a good, it's going to bolster Newmont's profitability. I think if they don't screw it up, as big corporations sometimes are known to do. But it's kind of interesting because on the other hand, back in September at the Denver Gold Forum, the CEO of Burack said that they were not interested in acquisitions and that they thought it was a better use of shareholder capital to develop their replacement reserves with existing projects on their balance sheet. But then I guess I think it was at the end of December at a conference. It might have even been at the World Economic Forum, believe it or not. The same CEO, his name escapes me. I hate analyzing big mining companies, but he basically said they're selectively looking for junior acquisitions. And I mean, the reason being is that right now, as you know, for a junior explorer that has a quality mineral estimate and a quality asset and good mineralization, and they're trading for, a lot of these companies are trading at $15-20 per ounce in the ground, and so it's obviously ridiculously cheap right now. And I think you'd have to be crazy if you're a large producer and you need reserves to replace what you're depleting, right? Because that's the large producer's biggest problem, is if their depletion exceeds their rate of replacement.
Well, especially for Agnico Eagle or Newmont Mining or Barrick, where they're producing a couple million ounces of gold per year, because it's going to be difficult over 5, 10, 15-year periods or longer to replace the reserves efficiently.
Right. And you're not going to be able to do it with the projects on your balance sheet if you're these guys. So it makes sense to go out and look for juniors with credible reserves, or credible resources anyway, not necessarily reserves, in decent jurisdictions. So I do think at some point we'll start to see some of these, I think we'll see M&A activity pick up, and you'll start to see aggressive bidding for some of the better juniors out there.
Are those juniors some of them that you were talking about, or at least referring to? You didn't name any specific names yet. Do they have feasibility studies, or do they just have like NI 43-101s if they're listed on a Canadian exchange, and maybe they have a pre-feasibility study and they started to do their metallurgy?
I mean, it's all, they're all in various stages of advancement. One that comes to mind for me is Viva Gold. I don't know if you're familiar with that one. They've got a small gold project in Tonopah on the Walker Lane Trend in Nevada, and they've done a pre-feasibility study, but they've done enough. They've already knocked out enough of the environmental studies, and they've done enough technical work. So it's almost like a hybrid pre-feasibility feasibility study. And they're not going to have to spend a lot of money. They're going to do a feasibility study, but I think if they wanted to, they could probably go out and get financing to put in a mine. With what they have now, I think they may need the feasibility study to get some of the final permits that they need to start constructing the mine. But that's an example. I think I think it's trading, and it's a small resource right now. Although ultimately it looks like they'll be able to prove 1 million ounces. But there were some recent transactions in that area around where Viva's Tonopah project is, where junior projects were acquired for an average of about $165 per ounce in the ground. And Viva right now is trading, I don't know, I think around 15 or $20 per ounce in the ground. I mean, it's, in my mind, I think Viva is probably minimally a 5-bagger from the current price level, and it could be as much as a 10-bagger.
Well, unless it has the potential to build
open pit. They've done advanced metallurgic work on it. They know exactly how they're going to extract the gold. It's open pit. It's kind of a hybrid heap leach process that they're going to be using.
Is it going to be a large enough mine, though, to interest a mid-tier or a senior producer, though? So is it going to produce over 100,000 ounces a year of gold? So that's kind of the minimum starting point for what a lot of these larger mid-tier and senior miners are looking to buy right now.
Well, it depends. I mean, I think right now, if I recall off the top of my head, the feasibility study shows a 50,000 ounce annual production rate, but it's again, it's predicated on, if he can, Jim Hesketh is the CEO, and he's done many of these projects, taken them from start to finish. If he can get the resource up to 1 million ounces, the processing facility can be expanded to produce 100,000 ounces. I mean, and there's Anglo Gold Asante just bought two projects in the area that aren't much larger than Viva's, somewhat similar profile. And they're the ones that paid, 165 an ounce in the ground for the projects. So, and the other thing that could happen here is that Kinross's Round Mountain mine is not that far to the north of Viva's project, and they've got a huge processing facility, and they're going to start looking at going underground with their resource and mining it underground. But they're going to need some feedstock for that facility to get their costs down. And so this would be a perfect supplement for them, because you could truck the ore from Tonopah to their processing facility and process it there. So, Kinross, Anglo Asante, and there's one other company, a mid cap that operates in the area or has a project in the area that would be likely acquirers of Viva. I'd be surprised if Jim has the opportunity to start construction of the mine. I think this company will trade before that happens. Dundee's investment side of Dundee, Dundee, the Canadian mining bank, whatever, mining investment firm, they recently took a 20% stake in Viva, because their geologist sees the same potential that I do, and obviously Jim does, is that this is a 5 to 10 bagger from the current level.
And for our listeners out there, the gold miners actually have, so if you're a senior gold miner or a mid-tier gold miner, you have way better profit margins right now than silver miners. I was writing articles for patrons about 12 months ago that Pan American Silver was having balance sheet problems with their existing mines, and yet Pan American Silver went out and did a bunch of acquisitions. So I was predicting share dilution. Pan American Silver just went out and they bought producing mines with share dilution. They bought the producing copper and base metal mines and with silver from Yamana Gold, and then Agnico Eagle went and bought the other 50% of Canadian Malartic from Yamana. So Yamana was split up. There was a bidding war, but a lot of these larger silver miners, I mean, the profit margins right now at below 22 silver, not that good, but for the gold miners are good. So the gold miners have more cash out there, better profit margins and free cash flow, more cash on the balance sheet to go and do acquisitions than silver miners.
Yeah, and that's all. Another trend, now that you mentioned gold, another trend that's been going on is and Pan American and SSR Mining are two examples, and Fortuna is another example. Is that companies that were historically primary silver producers are now diversifying and buying gold assets, and it's stable. It adds a little stability and less volatility to the revenue stream, but you still get bang for the buck from the silver that's produced. I mean,
The free cash flow, the profit margins and the free cash flow are more consistent. Yeah, I agree, Dave. Most of these guys, like a Pan American Silver or Hecla, they're 20 to 50% now base metals and gold production. So they have a large mix now of base metal production, also gold production too.
Yeah, most of these miners that people think are silver miners, as you point out, that they're silver. The silver component of their revenue stream is 30% of the revenue stream now. So there's very few pure primary silver producers. Aya Gold and Silver is one. And they really should just be Aya Silver. And I love that stock. I love that company. And Silvercrest Metals, probably the purest silver producer right now. Aya also.
You just can't efficiently grow just doing silver. I mean, like the price is so volatile, the paper price manipulation, the profit margins aren't consistent. I mean, if you're a royalty and streaming company, you can't just do silver deals. So occasionally, if there's a silver stream available from a large base metal miner, they get in trouble financially. You can go and buy a silver stream. You just can't do silver only. Look at Silver Wheaton; they couldn't grow anymore, and they've had to restructure.
I was going to say, they changed from Silver Wheaton to Wheaton Precious Metals because it's gold and silver.
They couldn't do any more silver deals for growth. And a lot of the silver deals that they did initially, the first 5 to 8 years, they've had to restructure some good amount of them substantially. I mean, look at the one on Alexco. They've had to restructure others.
Yeah, that was a 20% silver. I can't remember if it was a stream or silver offtake.
It was a stream initially, and it was way too much. I think it was up to maybe 30% of all the silver production. So they were just going and locking up as many silver streams as possible, and way too large of a percentage of the production from the mine. It was making so. This is the problem with a lot of the early streaming deals is they were too large a percentage of the mine's economics. So really, after about 8 to 10%. You start to get dicey. I think Royal Gold was taking 50% of the gold stream from one of the mines. It was Mount Milligan, and they had to restructure the entire thing. And that stock crashed temporarily. This was like 5 or 6 years ago, crashed like 50% while they restructured the stream. And then within 6 months, the stock rebounded enormously. So occasionally you get that. But a lot of the companies in the royalty space, they've learned to not take as much of the mine's gold or silver stream. You don't take 30, 40, 50% or more, or 100% of all the gold production, because then you destroy the economics of the mine and you take away the incentive for the miner to actually invest in exploration then.
Yeah, I mean, it's revert back to the heroin example I used earlier with respect to the modern day traders or the contemporary day traders.
Well, the main problem
when you're a junior, especially when it's tough to raise capital or really expensive to raise capital, a lot of times, you do a streaming deal to get the upfront capital. It's like getting a heroin fix, but ultimately, the streaming deal can be a cancer to the profitability of the miner.
Well, I think the industry for royalty and streaming has learned, and I think they don't do as many of these large deals where they totally destroy the project economics of the mine and they destroy all the exploration upside at the mine. I think also the other part, and I think nowadays, Dave, if you talk to a miner that's building a mine, they'll talk about putting a smaller stream into the capital structure. The main problem is the banks. So the banks, a lot of these banks do not want to fund a lot of these mines. So unless it's like a copper mine for an ESG project or something like that, a lot of these bankers want nothing to do with financing mines. There's just so many rules, regulations, red tape to get all the debt required for a mine. I mean, look at all the hoops that have had to jump through just for the Mongolian copper mine. And that's like one of the best ones in the world. And the project financing was delayed over a decade.
Yeah, no, I mean, I can see why banks might have a tough time justifying financing mines, but there's banks that'll finance them, and then you get you get pools of capital like, Orion Finance, and they aggressively will finance mining companies. So it's, now a lot of these streams were put in during the 2011 to 2015 mini bear market in the sector, and it was next to impossible for juniors to raise capital outside of, selling your soul to a streamer.
Well, the streams were considered back then very unconventional finance, but now they're a normal part of the capital structure. So if you talk to a fairly large mine, say if it's like a couple $100 million or more in size, I mean, they're considering putting a stream on it. Because
if I was a shareholder, I would not want a stream, because a stream, it comes right off the top, right out of the revenues before your revenues.
Yeah, but if
filtered down through the income statement.
I'll do the counter argument here, but if the mine doesn't come in on time and on budget with the construction, the banks are going to say, fuck you, pay me. And the banks are going to take if it's like a small or medium-sized junior, right? And they had to bet the whole company on the one mine, or they only own one or two mines, right? The odds of them being able to raise the banks are not going to give them any leeway. So whereas the royalty and streaming company will say, okay, you don't have to deliver any metal on the stream for 6 months, 12 months until the mine is completed and you're cash flow positive. So that's the trade-off. The banks are not flexible at all on a lot of this stuff. So the banks are basically going to say, you have the term on the loan, you have to pay us, and that's it. You have to either sell out for pennies on the dollar. We control the board. The banks are very inflexible once they give out bank debt for mine construction, if the mine does not come in on time and on budget.
Yeah, unfortunately, the companies I cover haven't had that issue with banks. So,
well, I've seen a lot of problems. I mean, there was the Rainy River mine, so that was what all the billionaire mine investors that were involved in that.
I actually just wrote up New Gold's earnings for my next mining stock journal issue.
Yeah, that almost bankrupted the company, Rainy River. I mean, that thing was way, over $500 million extra for costs.
Yeah, I think the problem was with the deposit, actually, and they've got that turned around nicely. I think New Gold's gonna generate, unless the price of gold goes south, which I don't think it will, and the price of copper. I think Rainy River is going to be highly profitable in 2020 or this year in 2023.
Well, someone gave them capital to be flexible, but there were some very serious issues at one point. I mean, they were teetering on bankruptcy. That mine was just hemorrhaging losses, and they were having capital raising problems. It was a mess.
Oh yeah, no, and part of that was the market itself. The ability to rate. Until the market recovered the way it did after 2015. That was part of the problem with for them to raise capital. But yeah, it was a chore to get that thing turned around.
Well, if you borrow,
they still have, there's still some issues, inefficiencies that reverberate, but they're getting it ironed out. I think they've done a good job turning it around.
For other businesses and other sectors, the banks are way more flexible. But for mining companies, the banks, if you take out hundreds of millions of dollars or $1 billion or a couple of $1 billion in debt to build a mine, the banks are not flexible. I've just heard horror stories about capital raises, and the banks talk about replacing people on the board and forcing the CEOs fired, and telling like the CEO that you have to start making phone calls to sell the company. So, I mean, the banks are heavily involved in financing these really onerous terms for financing the mines, as well as precious metal market manipulation there with the refiners and other stuff.
Yeah, like I said, the companies I follow and invest in, I haven't had that issue when it comes time to financing their mine project.
Well, it's probably smart, but when you do like the Rickroll type of big mine finances and you're looking for a large mine, right, that the seniors might buy, then you have to deal with the banks, unfortunately. Okay, well,
yeah, it is what it is.
Well, this is why I like the royalty companies, Dave, because they don't have to deal with the headaches. The bankers just want to give them cheap debt to buy free cash flow and high profit margin. The royalty and streaming companies, they all have over $1,000 an ounce profit margins in these market conditions. So,
yeah, you definitely have to roll up your sleeves and dig in, and look at the bowels of a project when you analyze the junior explorers. But when you get it right, it's worth the upside. I mean, probably, my best pick ever was Silvercrest Metals at 16 cents back in January 2016, and that stock at one point hit 10, and it's trading around 550 now.
Yep, and we've talked about that in the past. That was probably one of the best calls of anyone in the newsletter industry in the last like 6 or 7 years for juniors.
I appreciate that. The funny thing is, the only reason I knew about it was because I was heavily invested in Silvercrest Mines, and I knew what they had with Las Chispas, and when I saw that it wasn't going to be part of the First Majestic takeover of Silvercrest Mines, I told the corporate development guy, I'm like, look, man, as soon as you take the new Silvercrest public, I want to be your first phone call, and lo and behold, that's how I got invested in it.
That was a spinoff, right? So it was
spun up. Management took it, and I think they're going to do that again. They've got I can't think of the name of the project, but they've got another project down in Sonora that looks highly prospective. And my guess is at some point they'll either spin that off, and go work, go build that project and bring in new management to run Silvercrest Metals, or I have to believe Silvercrest Metals probably gets acquired.
There's actually a book out by famous value investor Joel Greenblatt entirely about spinoffs, and actually it does apply to these too. The management team sees that there's hidden value with a certain particular asset or assets, and then they go and sell part of the company, and then they go and run the spinoff part of the company. So normally over like 3 to 5 year periods, these spinoffs tend to, especially if management team knows what they're doing, they tend to work exceptionally well. So that's something to look out for.
That's right. Well, Paramount Gold's a perfect example. I mean, the predecessor of Paramount Gold, I think it was called like Paramount Gold and Silver. And they spun off. I don't really remember the predecessor company that well. I think it was a silver, they took a silver project up to mine construction and sold it, and then they kept the project that they're advancing now that's in Oregon, and at some point someone's going to look at this and say it's super cheap and take it over, because they will eventually, they will get, I'm pretty convinced they'll get permitted for their mine, to construct and operate it. And I mean, again, this is an example of a company where it's trading at a just absurd discount on a per ounce gold in the ground basis. And they have another asset, another Nevada project that I'm guessing they'll sell the Grassy Mountain mine project and spin this project off and go advance that, because it looks like an interesting project.
So Dave, before I let you go, since I've kept you for over an hour, one last question. I know you've done a lot of shorting over your career at a bank and on as a trader at a bank, and then also with your newsletter. Should most retail investors be shorting, or do you think it's too dangerous for most retail investors?
That's a great question. I think I'll tell you what, because I have both newsletters, the Mining Stock Journal and the Short Sellers Journal, and the subscriber base to the Short Sellers Journal is much smaller. But I've found that on average and in general, the guys that subscribe to my Short Sellers Journal are more sophisticated than the average retail investor. So, a lot of these guys are extremely bright. They know how the markets work, and they know what they're doing when they're shorting or buying puts on stocks. So, I think if you really don't know how to do fundamental analysis, and you don't really understand or have experience, trading in the equity markets and the options markets, you probably should stay away from short selling, because otherwise you're just gambling with your money. But it is a way to exploit extreme inefficiencies in the stock market. and the inefficiency in this case is, companies that are absurdly overvalued. So, for instance, Bed Bath Beyond, I was recommending that as a short for a few years, when it was up in the 30s. So, now where is it, like $1.80 or something?
And I'm sure you know a lot more traders who blew up their accounts, but I've interviewed and spoken off the record to a lot of former bank traders, and I've just heard horror stories about when they blew up their trading accounts for the bank, and almost all of them, when they blew up their trades, it was on leverage or it was shorting. So even professional traders, a lot of them, when they blew up their accounts, it was doing shorting, and they mistimed it. So maybe they looked at the fundamental analysis and they mistimed something, or they were too greedy on a trade and they didn't take any profits, any money off the table, and they were overexposed and something changed in their thesis.
Yeah. And that's the way the incentive structure works on Wall Street is, you get paid handsomely if you're right, and you don't get penalized. Or maybe worst case, you might lose your job and you just go somewhere else when you get something wrong, when you blow up a trading position. So,
did you work with traders who blew up their trading accounts for the bank like a bunch of times and they still kept their job?
No, the guys that the traders at Bankers Trust when I was there for the junk bond traders were all very very bright and understood how markets worked. I mean, there were occasionally, a trader would take a pretty big loss, but we made money year in and year out for the bank.
Unlike a lot of, I think the Fed's just buying a lot of this garbage that the banks have losses on derivatives and stuff like that. So some of these banks are booking, it seems like every day they have enormous wins on their trades, but I suspect the Fed is probably buying up a lot of their losers.
Yeah, a couple of my biggest hits, wins, were from shorting junk bonds. And that was tough back then because the coupons were high because interest rates were a lot higher. Like the stratosphere bonds, and those things eventually went to zero. And ironically, Carl Icahn was on the other side of me because I was shorting the crap out of them. And I actually went and visited the property after it was up and running. And I called the trading desk from the top of the tower because the roller coaster was always broken. And it was broken. So
you're talking about this, you're talking Stratosphere Casino and
Stratosphere Casino, yeah,
in Vegas.
And I had a short position, and I called up the trading desk from the actual on my cell phone from the top of the tower. I said, here's who has the bid for these bonds. Go and short sell as many as you can. And another one that I made a fortune for the bank, not for me, was Cityscape. Cityscape was a corrupt mortgage. They were the subprime mortgage lenders before subprime was a big thing. 10 years later, and so I shorted the crap out of those bonds, and I think I probably made 50 cents on the dollar on those bonds.
Well, Dave, I want to thank you so much for your time today. If my listeners want to follow your work, how do they do so?
Yeah, my website's investmentresearchdynamics.com, and at the top there's links to get more information about my newsletters. And I also I don't do it as often as I used to, but I also post blogs. I do blogs that I post. I think the latest one on there, well, it's a John Titus video is the latest one, but before that I excerpted some commentary on Amazon.com and my short recommendation on Amazon.com from my short sellers journal. So that's there for free on the front of the blog.